Welcome back to another episode of the Indy Investor Pod. I am Brett Snodgrass, and I'm hosting today's show with my good buddy Scott White, and we're diving into tax sales, how to buy tax lien certificates, where to buy them, and what are the things to look out for when buying tax lien certificates. So let's get to the show. And welcome back to another episode of the Indy Investor Pod. I'm with Scott White. What's going on, buddy?
I'm good. How are you, Brett?
I'm doing fantastic. Thanks for being on the show today. Always appreciate
you having me. Yeah,
always
absolutely.
appreciate our chats. It's always fun.
I enjoy it. I've enjoyed working with you a little bit. I know that I've purchased a few of your properties in the past few months, and I appreciate that as well.
Yeah, definitely. Well, I just before we really dive in, when I think about tax sales and tax lien certificates and everything that gets involved, I'm not an expert on that. I'm going to raise my hand. I've never been to a tax sale before, which is very unusual. Right? That's just one way that people buy properties or, they acquire properties. And I know that you've been doing this for a long time now, but I want to give just our listening audience out there, who is Scott White? How long have you been in real estate? And kind of what's your niches that you're involved in?
No, great. Thank you. So I've been involved full-time investor for about 16 years now. I started off like a lot of investors do, and I still am active in single-family houses. I've done a number of multifamily or reasonably sized apartment complexes. I still own some apartments. I've obviously, we're talking about tax lien sales. I've been involved in tax lien sales for I think 12 years now. Done a little bit of a lot of areas of real estate. I've lent a lot of hard money. I'm still lending some hard money. I borrowed hard money. I purchased notes. I purchased a lot of liens, and I just look for anything that I can add value to and anything that effectively works. And right now, my model, I would say, predominantly revolves around multifamily, tax liens, and I still sprinkle in some single family homes.
Awesome. Sounds good. So 16 years, that's quite a ride. Did you do anything before real estate and during real estate? Have you been full-time for that long, or did you go?
No, during real estate, have not done anything else since. Before that, I'm very analytic. I was a financial advisor, stockbroker for a number of years. Worked with a bank, sold their in-house securities for a while. So I'm wired that way. I'm wired very analytically. I love underwriting, let's say, larger multifamily deals and vetting any type of investment. But since I've been doing real estate 16 years ago, my first single family home that I bought, I actually didn't have a lot of capital. I took a large cash advance on a credit card, and I bought a single family house. And then this is before anyone had the acronym of the BRRRR method. I was burring a lot of properties. And then I got to a critical mass, started buying some apartment complexes. When I say critical mass, I had a number of houses that I was burring. I was able to refinance them. We had strong cash flow. And then I was able to pull out debt to buy an 80-unit apartment complex. And then I bought a larger apartment complex and kind of went from there.
That's awesome. Wow, that's some big stuff. You definitely go big, and that's awesome. So I'm really just here to pick your brain on one specific subject that I know you can talk about a lot of different niches as far as property management, single family houses, retail flipping. I know we've talked about the zones. My mind just went blank. The opportunity zones. Yes, I know you're really big into that because we've talked about that. But I know you're really huge into tax sales, buying tax lien certificates. We've had that conversation. That's what this show is really going to be about, as we haven't really had a show that really dives into that specific subject because it's foreign. It seems a little bit more complicated and all that. But I want to kind of just start back. So you go to the tax sales in multiple counties. When did you start doing that?
Yeah, great question. So the first lien sale I went to, I think, was in 2008. And I went with limited capital. I just wanted to get some experience, get some exposure. I think the first lien sale I went to, I may have purchased 5 or 6 liens. And then it kind of grew organically from that. I would each sequential year, and this was originally in Marion County. Now I do about 8 different counties in Indiana, and I focus only on Indiana. It's very state specific, so the way the legalities and the laws write out, each state's got to be completely different. I specialize in Indiana. It's my backyard. It's where I live.
Awesome.
Since '08, kind of grew organically from there. Had a liquidity event where we sold a few hundred units of apartments in the first quarter of 2016. And from that, just kind of doubled down on tax lien sales. Couldn't find anything to really 1031 those funds into. So I paid the tax. We went ahead and just did a lot more tax lien sales and any other investments we could find. Again, we bought some other smaller apartment complexes, but really went on a larger scale. So I've been doing it on a reasonably large scale, I would say, over the past 4 years now.
Awesome. Sounds good. Well, I want to just ask you some specific questions. I want this show to, if someone's listening here, to really just know about Indiana tax sales. This is the Indy Investor Pod, so we're very specific to Indianapolis investing. So I want to focus on the Marion County tax sales. So can you kind of just explain, if someone's interested in going to the Marion County tax sale, talk about like when they are first, and then where you.
Sure. So Marion County, historically in the past, they've had 2 tax sales annually. Now they only have 1. So the tax sale, unless there is an error, the tax sale is in the fall. This year it's in October. I believe it's right around October 15th. It's always someplace around late September, early October. They did have one on Valentine's Day earlier this year, but that was slated for last October, and there was just a clerical error, so they had to postpone that sale. So I went to the sale this past February, and I do, of course, plan on going to the sale here in October.
Okay, awesome. So they have one each fall, and how do you get the lists of properties? Is there a list of properties that are going up for tax sale? How do you know what's being sold?
There is. It's on the auditor's website. I don't even know at this point if it's on there yet. I usually start my due diligence around August, is around when the list comes out. So I think it's a little premature to really have the list out at this point, but they'll put it out sometime in August. You can download it off the auditor's website. Actually, you can actually go downtown and you can purchase a disc for a few dollars that has the Excel version of the list as well. So that'll get you the information you need. That list will have the parcel, the parcel number, the legal description, the address, which can be misleading. You really need to go by legal description and parcel number, because a lot of times the addresses won't match up. Yes, so you can get that and then just scrub the list and look for areas that you're interested in and do your own due diligence.
Awesome. So when it comes to Marion County, how many properties are typically sold at the tax sale or on that list?
Right. That's a great question. So it has reduced in recent years for a number of reasons. The economy has been good, so more people are actually paying their taxes. To be eligible for the tax sale, a parcel has to be at least 3 cycles behind on either taxes or special assessments. So as you know, we pay properties here semi-annually. So you have to be a year and a half back behind on taxes to be eligible. And from that list, sorry, I lost my train of thought. Repeat your question.
Yeah, the question was just, on average, like, what have you seen? How many properties are typically on that list?
Thank you. Historically, in the past, there's been upwards of 5,000. Now, when the list comes out, there's generally between 2,500 to 3,000 parcels. However, that list is updated on a daily basis as properties, as people pay the back taxes, properties get current on taxes, or at least have a payment plan, that gets reduced. So by the time the sale actually happens, it's much less than that 2,500 number.
Okay. So when the sale happens, what's your experience been? Like how many typically go up? 1,500, 1,800?
I think that's fair. I would say somewhere between 12 to 1,800 generally go up for the sale. And Marion County, what we're talking about, they hold it in 2 days. This past Valentine's Day, they actually held it in 1 day, and they did not have a lunch. They did not take a break. It was, and there were less properties because originally it was slated to last fall, but people paid a lot of those taxes between fall and Valentine's Day. So overall, it's a 2-day process here in Marion County, just because we have so many parcels. Most counties here in Indiana, actually, I think every other county besides maybe Lake County, and I haven't done Lake County, I'm not sure about that, but it's a 1-day process. So they can have the tax sale. Smaller counties that don't have that many, it could be an hour or two. It could be very, very short, but we do have quite a few parcels here in Marion County, of course.
Awesome. Sounds good. So I'm just going to kind of lead up to the actual tax sale. So number one, you get the list of properties. There's 1,500 properties going to go up for the Marion County tax sale. You talk about due diligence. So I don't know if that's different when you're going to a tax sale versus just looking at one of our properties and looking at how much rehab it needs and how much, looking at the price and the comps and all that. Is it different due diligence when it comes to tax sale properties? Like, what do you do for your due diligence before knowing like what to bid on these tax sale properties?
It's very similar, but it's to a much lesser degree. So, for example, if when the list comes out, let's say 2,500 parcels, I will scrub that list and remove parcels that I don't have any interest in. However, I'm still driving 1,200 to 1,500 parcels is what I'm driving. And when I go out on a day, I'll have someone with me. We'll pull comps in the field. You can do very limited due diligence. A lot of these properties will be occupied. Some will be vacant. They'll be in the complete gamut of condition. So your due diligence is what I call very quick and dirty. We have a rating system for the area, our thoughts on the condition of the property. We'll take specialized notes if it has a detached garage, if it has a newer roof or older roof, just generally what the condition looks like. So we'll take some very quick notes. We'll also take some very quick notes on the area. If we like the area for an investment, if this is a property that if we actually picked the property, we would not hold it, we would just wholesale the property. If it's in a path of redevelopment, if you have a lot of regentrification going on in an area, we'll note that, and we can be more aggressive at the sale. So the way that we analyze things is much less than if I'm actually going out and, let's say, either purchasing a house or an apartment complex for twofold. Number one, the amount of due diligence you can do is much less because you really don't have any legal right to be there. You can do a drive-by. If the house is vacant, we'll peek in some windows, but that's about it. Mm-hmm. And also for the volume that we do, when I go out and look at properties, we'll look at 80 to 100 properties a day. So there is no way that anyone can go in and, even if the property is vacant, and create a rehab list and replicate that 100 times a day. So it's we operate with a good, what I would call, margin of safety, in that we're conservative with our bids, but we still bid enough that at times we've made mistakes and we get burned every once in a while. So that happens.
Yeah, definitely. So that's just a huge number. You actually look at 1,200 to 1,500 properties, which that's a large number. That's like what, 67% of the list or something. So do you go in personally and think that, you could potentially bid on every property, or I guess you weed some out when you look at them, but mm-hmm. When you look at all those properties, like, how many do you personally go into a tax sale thinking I could bid on how many properties?
Yeah, great question. So we will go, and let's say if we drive the 1,200 properties, I would say out of those 1,200, 800 I have interest in. 800 I have interest in to some level. 400 they're just not worth the time or the effort. You do have some fixed expenses with, you've got some legal expenses if you actually acquire the property through a tax sale process. You're also going to be on the hook for some additional tax. It's not like you're buying a lien and they prorate the taxes to the day of closing, or you pick up the tax deed if you get that far. So you have some future taxes to pay, and you're paying the back taxes. So, however, by the time that you get to the sale, you also, for tax sales processes, you do a lot of due diligence on parcels that will redeem before the sale. So out of those 800 that we're interested in, roughly half of those will pay the taxes right before the sale or some period before that. And by the time that you get to the sale, my list is effectively dumbed down to say 400 or 500 parcels that I have interest in.
Interesting. Okay, awesome. So let's you got your list, you've got your due diligence done, you're going to this tax sale, Marion County auction, you're going to bid on 400 properties. So what does someone need to bring with them to the tax sale? Like what, and where's it at?
Great. It's all cash. It's an all cash sale. So you either have to wire in funds, bring cashier's checks. So we'll wire in a minimal amount, an amount that we feel that, conservatively speaking, this is the least that we'll spend. And then I'll bring cashier's checks in blocks for amounts above that. So
You actually wire money, and if you don't, what if you don't spend that money?
Then it'll take about a week, but the county will refund the money. They'll send you a package of the liens that you bought, and they'll send you a cashier's check in the mail for your unused funds.
Gotcha. Okay.
So with this, we'll bring in the funds. It's not a situation that you can bid on parcels, and there's no financing on these parcels. So you either have the funds in some faster than another, whether it's from a home equity line that you have, just capital that you have a partnership with other investors, and you reach some sort of agreement, but it's an all cash sale.
Awesome. So number one, you gotta have cash. You can wire it or bring in cashier's checks. Where's it located at?
It's downtown, the City County building, 200 East Washington. It's on the second floor in a big auditorium room, and it is competitive. It's very competitive in Marion County. Mm-hmm. You have the room is standing room only. Actually, if you're interested in the sale, you have to register to go there. It's so competitive and it's so busy there that unless you have a bidder paddle and are actually bidding on a parcel, you can't get in because there's no chairs available.
Gotcha. So standing room only. What are some of the other expectations you talked about? Are they just kind of go off one at a time? Is it very fast and people are just bidding and just one right after another? And
yeah, great question. It is very quick. It's my favorite 2 days of the year because there's a lot of energy in there. There's a lot of things going on. I'll have print offs on my list. I'll have, and basically all I'm really interested in is I'll create my list and I'll have the max number I'm willing to spend. Mm-hmm. So for example, if I'm willing to spend $40,000 on a lien, that's what I'm focused on. And once it hits $40,000, my bidder paddle comes down and I'm no longer interested in that parcel. So it is very quick, very fast and furious. As far as the process is concerned, they'll have a large screen and it's actually ran by the county, and they do a fine job. They'll have 25 item numbers. Each item number is a parcel that they'll auction off, not together, but the item numbers will be on the screen together, and someone will call out number 73. And then the screen will change. It'll have the legal address. It'll have the minimum bid, and the bidding goes from there. After that one's sold, then it'll revert back to the other screen with the remaining of those 25, and someone will call out another item number, and then they'll start bidding on that parcel. So a lot of the parcels, I don't want to say a lot, just because real estate is so hot right now, more and more of those parcels are being sold. However, you still have parcels that aren't sold. You still have burned out properties in rough areas. You still have landlocked parcels that really don't have much value at all. Or sometimes the back taxes and civil penalties from code enforcement and other agencies are so high, they just don't make sense to purchase the parcel for that amount of risk.
Yeah, definitely. Awesome. So that's the experience that you get from the Marion County tax sale. So I want to get into just the kind of the logistics on what you're really buying. Um, you talked about $40,000. Well, that's a big number for back taxes. A year and a half goes by. There's probably not a lot of properties that owe $40,000 in back taxes. So that number is more than the back tax amount. So can you kind of explain what you're buying and how you come up with these numbers, I guess, on what to
Sure,
bid on a tax sale lien?
sure. So I can't give you all my secret sauce.
No,
I
you're
can't give everything. But overall, when I say $40,000, we will run our quick analysis, and we will come up with what we think the property is worth in its current condition from what we can see, even with our margin of safety. And we are willing to pay a percentage of that. So if I say we're willing to pay up to $40,000 for a lien, we may have the expectation that in today's market, that property is worth $60,000, just to have a number. But we're willing to pay 40 for the lien because we have a lot of additional risk in there, because you're actually not buying the property, you're buying a lien on the property. So that's very important to know. When you go to the tax lien sale, you're not buying parcels. You're buying liens on parcels. You're buying tax liens on parcels. As you well know, I'm sure, a tax lien will effectively trump any of the lien on a property. So it'll trump a first mortgage. It'll trump any kind of mechanics liens. The only thing that really survives a tax lien is code enforcement type violations, what's called policing powers. If the city actually has to mow the property, if the property's in disrepair and they find the property, those will survive the tax lien sale and the legal process after that we put all our properties through, called a quiet title. But effectively, as far as the way that we vet it, so we will base it off a percentage, like I said, of what we think the property is worth, and then we'll just bid that amount. That $40,000 example is not a situation that property is that far delinquent on taxes. That property may be $5,000 delinquent on taxes. So, but it's competitive bidding. So the open market can drive that value up as high as what the open market will dictate.
awesome.
So the way the returns work, do you want me to get into that real quickly, Brett?
Yeah. I want you to just explain just the kind of the returns as far as, so let's just take that one example. So let's say they owe $5,000 in back taxes and you bid $40,000 on that lien, and talk about, if you were to get paid back, talk about that a little bit.
Yeah, great question. So the vast majority of the time, in a very, very quick analysis of the tax sale, and I tell people this all the time, if you're interested in buying a property for a reasonable price, the tax sale is a very inefficient and ineffective way to do it. It is, because the vast majority of the time, you're actually not getting the parcel. You're getting your capital back, plus a rate of return. And that holds true, I would say, any county here in Indiana. You're going to be more likely to get the property, or to actually acquire the collateral, acquire the parcel in more troubled areas. And the way to look at that is, if someone's house is worth $100,000 and they're $5,000 behind on taxes, they're not going to lose their house off a $5,000 lien. I mean, they're just not. And largely, they're going to have a mortgage on their house as well. So if the individual doesn't redeem, the bank is going to redeem. And then the bank will foreclose on the owner if the bank's not getting paid. And then the bank will sell that on the open market. So back to returns if a property is redeemed, state of Indiana, from day one on the base bid, so that $5,000, the back tax in our example, you effectively get 10% from day one. So, and then after 6 months, you get additional 5%. So let's say if I buy that lien and someone redeems it a month later, I'll get 10% off that $5,000 or $500. If they redeem it 7 months later, I'll get $750, which is that 10% plus the 5%. And then on the what's called the surplus or the overbid, which is in our example is $35,000, state of Indiana, you currently get 5% prorate. So that's calculated on a per diem. So you'll get, your per diem of $35,000 if they hold it for the entire year and they redeem on the very last day effectively, you're getting 5% on that $35,000. If they redeem it the day after the sale, you'll get a few bucks for one per diem of that $35,000.
So if they redeem it 6 months, if let's say that, let's do the 7-month example. So if they redeem it 7 months, you'll get 15% on that first $5,000, and then the other $35,000, the overbid, you'll get. How much will you get? That will not be. You won't get 5% of 35,000. You'll get a prorate basis might be 3%.
Yeah, maybe my math's a little fuzzy.
It's all good.
Right, yeah, if you're in the prorate of that, whatever that is, 5% for for 7 months at the 5%.
Okay. Awesome. So that's great to know. So that's in Indiana. Every state's a little bit different, guys. So check out your state, but we're talking about Marion County, and this is Indiana tax sale laws here on what you get back. So let's just kind of dive into a little bit on the post-tax sale. So let's say you win that $40,000. You bid $40,000. What are some of the things you have to do after the tax sale? Is there a waiting period? Do you have to hire an attorney? Like, what's that look like?
Great question. So that's going to be county specific. We're talking about Marion County. So Marion County handles all their own what's called servicing and notification. So here in Marion County, there's not a whole lot you have to do. You can track on the auditor's website if your property is redeemed every day if you'd like. But overall, during that time after the sale, you don't have to hire an attorney to notice the lien holders or owners of interest. You effectively, there's a 12-month redemption right for that. So after you go to a sale, let's say in October of this year, and you buy that lien for $40,000, you effectively have to wait an entire year. The owner has 12 months, or the bank has 12 months, or anyone that has interest has 12 months to pay the back taxes and penalties on that property. If they don't, then you could actually surrender your certificate that you purchased and petition the court for a tax deed at that point. But again, that's at least 12 months after you purchase the lien.
Gotcha. So 12 months goes by and they don't redeem it. What do you have to do to get the property?
Yeah, at that point, Marion County, you have to pay any back taxes. If there's mowing fees on there, code enforcement violations, you have to pay all or at least part of those. If there's civil penalties from code enforcement, you'll have to pay a reduced amount of those, and then you'll have to get the property in compliance after that, of course. But and then you effectively surrender the certificate, and then it'll go through the legal process of issuing you a tax deed. There's of course risk with that. There's I've surrendered certificates, and there's been sales that have been reversed. It's not a slam dunk like you're going to buy a property off, let's say the MLS, and you purchase it with an insured closing. So you're actually issued a tax deed. You don't have an insured closing. If you actually do receive the tax deed, so we'll fast forward here. So I'll go to a sale this October. I'll purchase that lien for $40,000. It doesn't redeem. Now it's October 2021. I'll pay the additional tax. I'll petition the courts. I won't receive that tax deed generally till February of 2022. So it's a long process. So from the time that you go to a sale, if you actually do receive the deed on a parcel, it's called an 18-month process.
Wow. That's a long time. So just want to kind of dive into that. So we've kind of talked a lot about just the process, guys. We talked about doing your due diligence, where to get the tax sale lists, what the tax sale experience looks like when you go to the actual sale and the auction. people bidding. We've talked about some of the post sale. We've talked about the returns that you get from the tax sale if they do redeem you. And so I just want to just to kind of tie it all up here, Scott, is obviously you've been doing this. Obviously, you think there's a lot of benefits to doing this. For me personally, I mean, you can get some good returns. You might get the property in 18 months at a pretty good deal. Obviously, what are I want to talk about the benefits and the drawbacks. Like you obviously think there's a lot of benefits to this. So can you talk to us about like, why do you keep doing this? What do you see is beneficial for you to buy properties or certificates this way?
Yeah, great question. So again, when we sold the apartment complexes that we had back in 2016, it was a good place. It was a safe investment for us to reinvest the capital that we had. I dabbled a little bit in the financial markets. Nothing worth bragging about. I didn't do that well, and I'm not a stock guy. I'm not a financial market guy. I'm a real estate guy. So I wanted to have something tangible that I understood, and I've understood the tax sale for quite some time now. So even if it wasn't getting the returns that I'd experienced in either multifamily or other areas of real estate, it was a safe place to park money for me. So that's one side of it. When you actually do acquire the property, and again, it's more the exception than the rule. So we'll purchase a few hundred liens a year, and out of that, we'll pick up, call it 40 properties out of that. So maybe 1 out of 5, 1 out of 4 properties that we'll actually acquire. And we have somewhat of a shotgun approach. Again, you can try to focus on other areas where you would have a larger, what I would call penetration, or a larger conversion rate. Properties that we're not interested in, I'll tell you, I'm not interested in a really commercial property that's worth $3 million just because I'd have to pay so much for the lien, and 99 times out of 100 it'll be redeemed. Mm-hmm. So when it is redeemed, our return on that is somewhere around 6 or 7%, which is fine by me. I'm comfortable with a 6 or 7% return on passive capital. Mm-hmm. When you actually get the property, you can do better. Of course, there's more risk on that, but it's worked for us because for this short window that's coming up, I'm talking about August, September, and October, I do a lot of due diligence, and we're able to deploy a good amount of capital. And I know that capital is safe for us for the next 12 months. And I've basically front loaded things for the next 12 months. And then when we get those properties, we do well with those properties. But overall, even when we get when people pay their back taxes and we get the capital back, we do very well with that too. So we're happy either way.
Awesome. Sounds good. So let's just kind of talk about the drawbacks real quick before we wrap up the show here. So who would you recommend not to even look at this?
I would recommend if you want to get involved in real estate and you're a first-time investor, I think there's better avenues to learn, because this is very passive and it's a longer process. So if you want to be involved in either flipping or rentals, this is not the best first way to buy a property, because let's say if you have limited capital, everyone has limited capital, but let's say if you have, in our example, you have exactly $40,000 to invest, and you buy this one lien. Well, you could sit on this one lien for, call it 9 months, and then they pay the back tax and you get your capital back. You get a little rate of return. But if you wanted to be more active, I would not advise this. If you want to be more active, I would advise actually going out there, acquiring properties, procuring financing for some additional properties, and growing a business that way. Again, I think this type of investing makes a lot of sense if you're either targeting specific tax liens that are coming up for the sale, and you basically said, I want that one particular lien because it's next to one of my rental properties, and I may get it, I may not. Or if you have capital that you want to invest and you just want a good rate of return on that capital, and you understand the process. If you educate yourself and understand the process, you can do well with tax lien sales.
Awesome. Sounds good. Well, thank you so much for being on the show today, Scott. So much wisdom here, guys, just about tax sales. If you guys are interested in this, just, replay this. There's a lot of information here. And Scott, he's just a man of wisdom. He knows his stuff, definitely when it comes to tax sale. And Scott, like, if someone has a question for you, is there a place that they could ask you, reach you? And I know you're a busy guy, but I don't know if you'd have that
Sure. Sure,
opportunity.
sure. No, I kind of have blinders on the world. I'm not a huge self promoter. I'll be happy to give up my email address. It's just scott@apexindy.com. The name of our property management company is Apex Property Management. So it's SCOTT, two T's, at Apex, APEX, Indy, INDY.com. Feel free to reach out. I'll offer any kind of insight I can. And no, happy to help.
Sounds good. Well, thanks again, Scott. And thank you for watching this Indy Investor Pod. I really appreciate you guys, all the questions that you're asking. And we're just trying to bring the most value that we can when it comes to Indianapolis investing in Marion County. And that's why we put on this show. If you want to reach out to us or you have a certain topic that you want us to discuss, you can reach out to me on Facebook. Just search for Brett Snodgrass, or you can reach out to Brian Snyder as well. Also, check out our groups. We have the Wholesaling Made Simple group too, if you want to join that, and you can ask any questions on there as well. So thank you guys so much. This wraps up the Indy Investor Pod with Scott White. Appreciate you, Scott. Have a great day, man.
Thanks, Brett. You as well.